Hello everyone, today is January 14th and this is our session number 2 of the WICAF trading course. We had a really good session, first session, it was a lecture session. Today, just because we haven't covered a lot of the material last time, or at least as much as I planned to cover, we're just gonna probably be still in the lecture mode today, but starting from the next session where we will discuss the homework on accumulation, specifically Home Depot, that would be the case study for us for homework. Then I will start pulling out people and we'll start conversing and we'll start talking and we'll start analyzing. So we'll get to this point. Don't worry about this, guys. The main thing to remember is that once you have the homework, what I really would like you to do, and this is going to be extremely important to us, is to submit your homework in a specific way. One file, either PowerPoint, PDF, or Word doc, and then put your first name with the last name initial in the name of the file. Email it to me, to my personal email. I've sent out instructions for the homework, and I've mentioned that my personal email, simplecot@hotmail.com, is the one that you should use. I will remind you again. I will email you again. I will also email you tonight the home page for our class. So this page usually will contain the videos and the slides. So I will email you the link to this page because it's unlinked, so you cannot see this page on our website. And then I will email you the password to that page. It's password protected. And I would like to ask everybody to be confidential about the access information. It's only for your use. Okay. Let's talk about what we're going to cover today and what's coming. So session number 2, we're still on the price structural analysis. We're going to talk today about the change of character. This is a very simple concept, very elegant, and very powerful. So we will explore the reasons of why we need to understand the change of character, what it leads to, and what kind of assumptions, deductions we could make out of that on the analytical front. And then once we will understand that shift, that change of character provides, from one environment to another, we're gonna reside for a while in the environment, in the non-trending environment with the bias to the upside. So both accumulation and reaccumulation will be discussed. There, we will be discussing WICAF events, WICAF phases, and we'll talk about the phase analysis a little bit today. On the reaccumulation, we will have a conversation about conventional and alternative labeling. So we'll revisit that, and that will be extremely helpful for your homework. So guys, please pay attention, especially those of you who are going to do the homework. And then, time permitting, we're going to start covering price structural analysis points that are going to be related to both accumulation and distribution. But there are certain things, certain events, certain phases, certain shortcuts that I'm going to give you, and we'll talk about different characteristics for different WICAF events. So in this conversation starts today. For your homework, this is the one that we haven't done for this class. So this is going to be an accumulation labeling. And as I mentioned, it's going to be of the Home Depot. All right, and then in the next class, which is going to be January 21st, we're still covering price structural analysis. We will review our homework. So there will be a lot of questions. Every cycle, there are so many questions the students send in their emails with their homework. This is fine, you can do this. Just don't expect me to answer those emails via emails, because I just don't have so much time to answer each email that comes to me. But my promise to you is that I will look through all of your homeworks. That's number one. Secondly, I will identify what is the common theme for mistakes that we are as a group conducting. And therefore, those are going to be the primary questions that we're going to answer in our homework review. Also, with the homework review, this is the chance for us to establish that communication where I open up the microphone and somebody steps in, a volunteer, and then we go through the chart first, and we go through the logic of labeling, how we're labeling the chart, what's going to be the first thing to label, what's going to be the next thing to label, and so on and so forth. So please be prepared for this type of the conversation, for the discussion of the homework in the next class. Then we're going to continue exploring all of the price structural analysis points, distinctions, something that, we either gonna cover more, or we're gonna cover in general. There's gonna be some distributional things that I'm gonna add to this as well. And next session also will be devoted to a distribution. So we'll talk about Wyckoff events there, Wyckoff phases, the psychology of the distribution, and so on and so forth. And the homework is going to be obviously on a distribution. So you will have, 6, 7, 8 charts that you will have to label. And then we will review this homework in session number 4. So that's the plan for today and for the next session. As you could see, it always changes. It depends on how much time we have each session, how much material we cover. Sometimes we slow down because something is very important and we need to understand those concepts. Sometimes we actually, speed up. So we'll see how it's going to go. It's always kind of like a living, breathing organism. Okay, so the first concept that we'll talk about today is going to be a change of character. And that concept is going to be discussed for both accumulation and the distribution. So let's talk about the theoretical portion and the theoretical concept of the change of character. And we're going to start with a very simplistic explanation as to what are we actually looking for in the markets as we look at the price structure. And we definitely realize that there are 2 types of environments that we're expecting. First environment is a non-trending environment. This is the environment of a consolidation. We also will call this environment a trading range. We also will intermittently call this a non-trending environment. So all of this semantics regarding the trading range or consolidation are valid for us. So when you're going to say something like, okay, I'm looking at the trading range, I'm looking at the consolidation, I'm looking at the non-trending environment, I know instantly that we're discussing a trading range which is confined between the levels of support and the resistance, and predominantly which is going to have some kind of horizontal range where the price deviates around the mean horizontally. We'll discuss later on some other trading ranges which are going to be upsloping and downsloping. So, and we'll give the definition and also I'll give you the rules as to how to construct those. But for now, we are either discussing a non-trending environment or a trending environment. A trending environment is going to have 2 types for us, an uptrend and a downtrend. So that's how simple I want you to think at this level. And these are kind of like the basics. These are very simplistic stuff, but at the same time, I want everybody to be on the same page. So the biggest question that we have about these 2 environments, obviously, is for the non-trending environment, we want to understand the bias. We want to understand the timing of when the price comes out of that environment and starts to trend. We also want to understand the character with which the price will travel out of this consolidation. So those are the goals for us to explore analytically in the non-trending environment. And then in the trending environment, obviously, we would be assuming that we're already in the position. And if we're not, then we would be looking for another trading range, which is going to be a reaccumulation range in the uptrend. And this is where we would be looking for to establish the position. And we want to understand the character. So character is extremely important. And then the last thing about the trending environment is we want to understand where the stopping action occurs, reversal, and a switch into a non-trending environment. So those are kind of like the priorities for us with trending and non-trending environments. Having said this, when we are in the main thing between these two environments is that switch that I already mentioned. So we want to see, let's say, a non-trending environment. Then we want to identify some kind of switch which would lead us to a trending environment. We want to do this in reverse as well. From a trending environment, we want to identify the switch that will give us an understanding that we are going into now non-trending environment. So what is this switch? How would it look, and how would we see it? Well, first of all, the name for this switch is going to be a change of character. And the change of character, if you think about the name, a change of character. So it seems that one environment had a specific character and then it changed. So what has changed? What would give us an indication that a change of character has happened? So obviously a change by itself, as the word assumes kind of like a meaning of something is going to be happening in a different way than the way how it happened before. So when we talk about, let's say, one environment, which in this case on the schematic is a downward trend, and we would be thinking what kind of character of a trend it would be. So obviously the legs to the downside are going to be much more pronounced than, let's say, the legs to the upside, where we're going to have attempts to reverse and to actually cover the ground that we lost in the downtrend. And obviously those rallies are going to be smaller. They're going to be populated with some pockets of increased supply. This is where more selling is going to occur, and then additional selling is going to come. So it will not allow the price to go up significantly. And that's going to be, the main price characteristic. The main volume characteristic of the downtrend is going to be all about the increase of the supply on the reactions, and then diminishing volume signature or diminishing demand signature going into a rallying mode. And then every time we're going to have some kind of consolidation in the downtrend, we're going to structurally jeopardize the support area, and we're going to break to the downside. So that's going to be a repeated behavior until we actually exhibit a stopping action, which is going to be labeled by us as a selling climax. So then this is what we're going to have in the downtrend. And this behavior is not going to change until a certain point. So what is that point? That's the biggest question that we want to address. And that point is going to be a change of character. And think of this in reverse. I've just shown you how a downtrend would behave. Then think about that change of character. So if in the downtrend we had the price going down more than up, then obviously in the change of character environment, we want to have the rally that's going to start outperforming. That's number one. And probably on this rally, we want to see the increase of the demand. We want to see the presence, of buying. And usually that presence, because it's so early in the trading range, it's so early in the accumulation process, it's mostly going to be associated with the contrarian buying by huge institutions. We'll talk about this a little bit later on. Let's come back here to the change of character. So the rally should change. The behavior of the rally should change. And we're going to say that the distance of the rally should increase relative to the distance of rallies that we've experienced before on the way down. The upspread should increase. That's what's going to kind of propel our view on how buying is unfolding. That's what's going to increase the distance. That's what's going to increase also the velocity and the momentum behind buying. And we obviously want to see the change in the volume behavior. So we want to see the demand increase. We want to see volume increase in general, because it would signify to us that it's not only selling by weekends that we're experiencing on the way down into the climactic action, but also there is some buying behind this. And also on the automatic rally, that first change of character, first change of behavior, we want to see the volume increase. We want to see the demand increase as well. So it's in this area after the stopping action that we are going to see the best rally that we have seen in the downtrend. And right away, when we think about this rally and we think about that this is a possible change of character, we always thinking that the change of character will lead to the change of the environment. So we were in the downtrend environment. So now we would change that to some kind of consolidation. So we know that the trading range is going to unfold. We still don't know the bias at this point. And this is a little bit more of the advanced studies that we do in the practicum. There are certain things, certain ways of how you could identify possibly the potential bias of the consolidation in phase A. I will give you some of the shortcuts as to how to logically think about the bias even in phase A and as we go through phase B and specifically in phase C and D. But at the beginning, usually we're going to be questioning as to what kind of bias we have. We also will not know a specificity like a duration of the trading range that's going to unfold. Again, in the practicum, just because it's more for the advanced studies, we will create kind of like an understanding as to how we would measure a potential duration in the consolidation. So I think it's extremely important as well. And obviously, it's important to also understand the character with which the consolidation could unfold. Is this going to be a long-term range or a short-term range? How is supply and demand are going to behave? What is the behavior of institutions and weak hands around the edges of the trading range at the support and the resistance and so on and so forth? So quite a few things to address. But the main thing with this new rally, with the better rally, is that the change of character is possibly unfolding, and that would mean that from a downtrending environment, we are going to change into non-trending environment where we have to define the bias, where we have to understand the duration and the timing with which when the price is going to leave the trading range, and then the character of the trading range itself. The confirmation of this change of character is going to come on the next attempt to push the price lower. And this attempt will fail, and it will create a test, what we will call a secondary test. I often call this a local test to the local event, which is the climactic action. We will discuss the selling climax later on today, but for now, just keep in mind that this final test of the change of character, this is an attempt to continue a downtrend, which will always fail. And even if we have different secondary tests, we could have a secondary test that is going to be like shown here on the schematic, a high low. We could also have a test that is going to be a low low. And we also could have the test, which is basically going to be at the same level as the selling climax. So in all three cases, this is a successful test. Even though the lower low is being created, the lower low is just basically tells us that there is still some supply available or demand is still relatively poor, and that's what brings the price below the support. But they all three are going to be successful tests. Why? Well, because they recover after the test, they reverse, and they come back to the area of the resistance, therefore finishing the downward swing and reversing that swing. So again, something, for the future for us to remember. So let's come back again to the change of character, as we're experiencing our first change of character in the consolidation, and there are, by the way, two of those. One is on the way into the trading range, and one is on the way out of the trading range. Change of character, you could also say the first one is in phase A. So what is happening here as well? Well, we said that the price is going to look different, the volume signature is going to look different, and then it's going to be confirmed on the secondary test. Well, why is all of this happening? Let's quickly kind of talk about this. Well, the first assumption that we have of why the change of character is happening is that the behavior of market participants has changed. So if we talk about strong hands, and we obviously would be thinking about hands like composite operator, huge institutional trend followers, big money contrarian type of traders. What are they seeing here around the climactic action? Well, what they see in a panic by weekends, which basically leads to, on the very technical physical level, increase in volume signature, and therefore a very substantial increase in liquidity. And by liquidity, I mean the availability of shares in big quantities. We always think about the CO as being limited by certain rules, by certain um, regulations even. What are those? Well, because of their big size, they want to open big positions. How do you open a big position in a stock that might be maybe like illiquid, right? So they would never go to this type of the stock. They need to be in the stock that is liquid, number one, and they need to invest at the spots in the price structure that is liquid. Imagine a big institution is trying to establish a position on a sign of strength or on the breakout or in the uptrend. What would that produce? That would produce such a big jump in price because of their size. So they need to cover their steps and open the position when they can, when liquidity is available to them, when shares are available to them and readily available. So a panic by weekends where either public or professional hands that are on the wrong side of the trade, institutions that are on the wrong side of the trade, they're having a panic, and meaning that they're capitulating and they're getting rid of their holdings quickly without any doubt that there could be a stop in action soon, and they're willing to do this at any cost. So that's what produces that increased volume signature, acceleration of the price to the downside, and that's what creates that liquidity that is needed by institutions. The next thing that they really need at this point is some kind of value proposition. They need this stock to be at the price that has a long-term value for them, because still thinking about the whole process of absorption of the supply that is available in phase A, they might be thinking that it's going to take some time for the price to stabilize and then for the price to start actually going up. So they have an understanding of the time horizon that they will need, and their one of the biggest two requirements to get into this position is also going to be the value. Is it worth it to me at this point of time with this price to get into this position substantially, or at least start scaling into the position? If the price is attractive, if the stock, in their opinion, is undervalued, they're going to come in and establish this position, at least incrementally. And because of their size, what's happening is whatever increase of the supply that was produced by the weak hands on the capitulation is going to start gradually be observed. And we could observe some of the situations where big institutions, CO type, contrarian institutions are already in the buying mode, they are accumulating, and yet some other institutions and the public, the weak hands, are still selling. And that's the exchange of shares that happens around the climactic action, and specifically selling climax. Panic buying by weak hands produces a lot of volume signature, a lot of liquidity, takes the price down to the point to the zone of value, and that creates those two conditions where big institutions that are contrarian are coming in and they're buying those shares. As they buy, the supply that is presented by weak hands is being absorbed by strong hands, and that stops the price first from moving further down in a very accelerated way. That's number one. Secondly, it stops the price then from moving further down. And thirdly, once absorption has happened at that local level, then the price could actually go up and create an automatic rally or a change of character rally. So, and that's the whole process around the selling climax. And that's the whole idea behind the change of character. So with change of character, again, is a change of behavior. And it's a change of behavior for both weak hands and strong hands. And visually, we could identify that change of behavior, which would suggest to us a change in environment. And from a trending environment, we're going to go into the non-trending environment. Okay, let's talk about the second change of character. That second change, as I mentioned, is going to be on the way out. It doesn't really matter whether it's an accumulation or a distribution. It's still going to be on the way out before the markup happens and the markdown happens. Actually, if we would be more precise, we could say that this change of character is going to be a part of the emergent trend. And by the way, I've talked about this in the last class. It's an extremely important concept for us from the point of view of timing. This is where all of our trades are going to originate. And this is where I'm going to lead you guys to both in the selection process and also in trade management. In our selection process, we just want to find this moment. We want to find the moment where accumulation has been either concluded or in the last stages of conclusion. And therefore, we could say in the last stages of absorption of the supply, whatever supply is available at that point of time. And the price and the volume starts to show a different behavior. What is that behavior by the price and volume? Well, the first thing that we will notice is that, again, on the price side, we want to see the difference between how the rally, the most current rally, has been unfolding relative to the behavior that was exhibited, of the same behavior that was exhibited in the trading range before. And here we would be comparing, again, the distance that the rally is increasing. This spread, the up spread, that is increasing as well and has a different type of look. We also will be talking about some gap activities there on a sign of strength. And then we also want to see from, let's say, the price behavior, the reactions on that sign of strength, how are they going to behave? Are they going to exhibit increase in supply? And if they do, would that supply be absorbed? If it's going to be absorbed, then how quickly it's going to be absorbed? We also would like to see the volume change as well. So rally and the volume. So here in the volume signature, one of the things that we're going to pay a lot of attention is increase of the demand or the consistency of demand. And that would identify for us the buy institutions. That's number one. Secondly, we want also to see what kind of urgency of the demand is there. That's another question, and that's going to address the character of the next rally and of the next trend, actually. So, and we'll study this more, in the second portion of the course on the supply and demand. So we'll talk about this. But coming back to the change of character, the concept is going to be the same as the concept of the change of character in phase A. We want to see the rally that is going to be better than what preceded it. So in the case of the phase A change of character, where we had the downtrend, we want to see the rally that was a better rally in the downtrend. And then we want a secondary test to confirm that there is no further continuation of the downtrend. In the change of character in phases C and D, we want, again, the same thing. We want to look at the rally and we want to say that this is the better rally of them all in the non-trending environment that we are currently in. And then as a confirmation, we want to look at the backing up action, and we're going to say that for the first time, this is the reaction that is so different than what we've seen before in the trading range. On this schematic, it looks even different. It's more horizontal than vertical, right? Than the reaction that goes down to the support. It still goes down to the support, but it goes down to the support now that has acted before as the resistance, and that's also a big difference. It's also a change of behavior, and that concludes a change of character. We also would like to see that the supply signature is going to be diminishing. And there are quite a few variations on the supply, how it occurs in phases D. This is again something over more advanced studies, for the practicum and for the second portion of the course. But generally, we would like to see that supply and the backing up action or last point of support is going to have those, contracting elements, or if supply comes, the absorption happens much faster and much easier. So we'll talk about that. All right, so these are the two changes of character. Again, change of character in phase A, that's going to be on the way into the trading range. Change of character in phases C and D is going to be on the way out. And it doesn't really matter whether it's accumulation, reaccumulation, distribution, or redistribution. It's going to unfold the same way. It's going to have some variations. You might have a variation where, let's say, a buy-in climax happens, and then you have, very frustrating increased, diagonal formation, where the change of character might come slightly later on, and we usually talk about this in the practicum. This is a little bit more advanced, and then have a trading range. So, something like this obviously is just a variation on the theme. But once you identify a change of character, then you know what's going to happen next. Most likely that's going to happen as a trading range. The same with the distribution. We're looking for the climactic stopping action, and then we're looking for the first reaction that's going to be so different than any of the reactions that we've seen before on the way up since the last meaningful consolidation. And then after that, as it suggests a consolidation, then we will be thinking about, okay, well, in this consolidation, what is the bias? and then what is the timing as to when the price is going to leave the trading range, and then what is the character, and so on and so forth. Change of character in the distribution on the way out is going to have the same characteristics as an accumulation, only reversed. We're going to have the reaction that is going to be the best reaction in the current environment, which is a non-trending environment. And then after that, it's going to be confirmed by an attempt to rally that is going to be the worst than what we've seen in this distribution formation. And therefore, we are confirming a change of behavior and a change of character before the actual move to the downside. One last thought here on this slide. Please note that structurally, we always talk about Wyckoff layers, right? So when we talk about, let's say, specific volume signature should be this and such, in a specific phase. So I want you to think about the change of character and think about Wyckoff phases and Wyckoff events and where a change of character usually would occur. So on the way in, whether it's accumulation or distribution, that's all going to be in phase A. And you're always going to be looking at the automatic respond or automatic rally in the accumulation and automatic reaction in the distribution as those first two counter to the trend events that going to lead you to the conclusion that this is a change of character and therefore we are going to start a non-trending environment. And then secondly, in phase A is going to be confirmed by a secondary test. So that's on the way in. On the way out, I want you to remember that the events, Wyckoff events that we're going to discuss is the lowest point of the trend in phase C for accumulation, the highest point of the trend in the distribution, and then a sign of strength, a major sign of strength, and a major sign of weakness, which are going to be followed by the small counter move to that. So you're going to be predominantly in phase C and D, and you're going to be covering the major sign of strength and the major sign of weakness as your first change of character lag. All right, any questions, any comments on this? And by the way, at any point of time, guys, if you feel that you have questions, just type it in or just say, I have a question, and I will come back to you and I can unmute you. But if there are no questions, we're going to assume that everything is fine here. So let's go to the next slide. And let's look at the examples of a change of character and how it unfolds. And I'm going to show you here. Oh, okay, great. We have some questions. So let's just address some questions first. Okay, let's go to Eric. Hey, Eric. Eric AE. Okay, so what's the question? Okay, Eric, I'm trying to unmute you. So you have to unmute yourself. Okay, check.
Hello, Roman.
Yes, hi. How you doing?
Hi. My big question is in the phase A or in the change of character. Mm-hmm. The secondary test, you say that can go below of the selling climax.
Okay, so I gave you 3 scenarios for the secondary test. We're discussing this spot right here. So still phase A. The secondary test acts as a local test of the climactic action. It basically tells us the story of the supply. Is there still a lot of supply left, or a story of the demand? What kind of demand we have there? And again, 3 types of secondary tests that we could have, right? So a test that goes and creates a low, a test that goes and creates a high low, and then a test that is basically on the same level. So what's the question?
Well, the question is when the secondary test go below the silent climax. So how to identify in the volume that the price will go up again to the trading range? Well, it's like the dove that I have.
Okay, I got it. I think I understand the question. Okay, so the question is, how do we know? Let's say if it goes to the lower low, how do we know that this is a legitimate secondary test? So that's the question. Well,
Thank you.
sure. Okay, okay, so you muted. Okay, great. So the first thing, there are a couple of things here that I want you to think, and we are definitely kind of like jumping a little bit ahead, but that's fine. I like the inquisition of the mind even at this point, so that excites me. Um, there are two things that we should consider here. The first one is if we correctly identified a selling climax, which is going to be a stop in action to a downtrend, and then we correctly identify the characteristics of the automatic reaction, or rally rather, in the accumulation. Then our assumption that the secondary test is going to come and it's going to be confirmed are probably very high. And even if it's going to create a lower low, that's totally fine. We just don't want this lower low to be significantly lower, right? So we don't want the price to fall, another like 50% and then say this is an secondary test. No, that's not going to be the case for us. It has to be relatively close to the support. So the action by which we identify a potential stop in action and automatic rally should lead you to the conclusion that even a lower low could be a secondary test. The second point here is all about supply and demand and the price reversal around the area of the support. So we will be observing specific price reversal patterns that are being confirmed with the volume signature. So for instance, a reversal of the last significant bar, we will talk about this more in April, March, and then increase in demand signature. That would suggest that demand is actually coming in, and it not only absorbs the supply, it actually pushes the price back above the support level. And that's when we're going to say that now we see a confirmation of the reversal, therefore we're going to have a rally up, therefore secondary test is confirmed. So we'll talk about this process, but a good question. All right, let's see some other comments here. A question from Rami. Automatic AR, is this an automatic rally? Excuse me. Depending on the context. Okay, so there are three ways of how I'm going to address automatic rally or automatic reaction. I'm going to say in general terms, automatic response. So it's the same, the same letters, AR, but obviously we want to say automatic rally for accumulation and reaccumulation. And we want to say automatic reaction for distribution and redistribution. And then obviously in the reaccumulation and redistribution, we're going to change that, and I'll talk about that. But for now, I just want you to remember that AR, this rally right here, is basically an automatic response. Automatic response to what? It's an automatic response to the change of behavior that we have around the selling climax. So in a way, it's an automatic response to the selling climax itself, what is happening at this point. We also sometimes mean that automatic, meaning that it's almost like a technical rally, right? So what would constitute a technical rally for us? A technical rally is something that happens just because there is a close of positions in the direction of the previous buys. So we had a downtrend, and a lot of professional traders were short in this market. And then once they see that the conditions are changing at the bottom of the selling climax, what do? They close their positions. So therefore, their short positions are being converted into the market position, which is a buy order. And therefore, they are not betting necessarily and gain the profits from the market potentially reversing and going up short term on the automatic rally. But what they're betting on is that this is going to be the low and I need to get out of this position because this trade is done. So in a way, their behavior is an automatic way of pushing the price up. So sometimes I think about automatic response as that, automatic covering of the short position by those who have profited on the way down. So that's why it becomes an automatic response. Okay. Should we wait for stopping action or selling climax before we get out of the existing position long and short? From Nilesh. Okay, I'm sorry if I mispronounced your name, and I'm glad that you joined us for this session, so that's great. So we will address this a little bit later on. Then the next question from Joe. Is there any big news usually associated with what, Joe? With the selling climax? With the secondary test? We'll talk about this as well. Okay. Okay, was the selling climax. Okay, well, as long as we're here, let's just, address this, and then we will come back to this slide. Yes, selling climax is going to be associated with a big event, and that big event usually is going to be the price action itself. So for those of you who watch, let's say, CNBC, right? I usually don't watch it that much at all. Only watch it at the points of interest. CNBC or any other, TV shows could act as a contrarian tool, could act as a sentiment tool, and usually when, let's say, a stock is exhibiting some kind of panic where the price is going down so quickly and there is a lot of selling by weak, strong hands, how do you think that's going to be? It's going to be portrayed on the TV. So usually they're going to say Apple has a gap down like it has recently has had, and overnight action is going to show us the gap to the downside at the open. The volume is very high, and it's going to be in the news, especially a stock like Apple. I mean, obviously a small stock, not an interesting stock, nobody would even care, but something like Apple will have a spot on the TV show as a concern. So that would be a big event for the stock itself. Having said this, what obviously Joe meant is the event something like earnings, right? Or the reaction to earnings, a change in management, some kind of, big numbers that are coming out on the revenue, on the sales, and so on and so forth. So those could all be big events and they could produce a lot of volatility up and down, a lot of liquidity, and so on and so forth. So yes, selling climax could be potentially one of those spots. And when we say big events, we usually think big volume, big liquidity. So, and selling climax is exactly that type of the event. Big volume, um, big point of liquidity, a lot of value. So could be both. Event as a price event by itself, and then some kind of catalyst event that are going to produce that price action. Yeah, really good questions today. I really like that. Okay, from Amel, are there a limit to the number of secondary tests in the trading range before the sprint? How do we identify a sprint versus a secondary test? Yes, okay, again, so inquisition by your minds at this point, bringing us a little bit faster to, where we should be. So I welcome all of these questions, but at this point, let's just kind of like note them, and we will answer as we go, as we uncover this stuff. Let's come back to the change of character. Let's look at some of the examples. So this is Yahoo. You guys don't see this, but this is Yahoo, and this is what, 2012, 2013, 14. And Yahoo actually was such a great trade out of 2012. There was a management change that came aboard, I believe in 2012. There was quite a big trading range that came out of the oversold condition. And then we went into the accumulation range, and out of that, we're looking at the latest phase C right here. It's out of that that we have the first leg to the upside. And this acts as a sign of strength in the backing up action. So by itself, it looks as a change of character relative to the environment that we've been in before. Do you guys already see where is the high probability point of entry for us? It's not necessarily in the area of the emergent trend. It's actually in the area where a trend has been confirmed. So where do you think the trend has been confirmed? Write it down really quick. Where do you think the trend has been confirmed for Yahoo? Give me the timestamp, like a month and a year. What is the highest probability spot for us to participate in this move to the upside? Okay, backing up and last point of support. So somewhere here, December, January of 2013, backing up of 2013, February, mid-October, high volume. Okay, great. So I will come back to October in a second, but everything else sounds really good. So what are we looking for as kind of like this final confirmation? Is the confirmation that should be giving us, a high level of confidence to follow up with this trade. It's probably going to be in a spot here after the major sign of strength, which basically tells us that the character now is to move the price to the upside and have small reactions, very, very small reactions. And this major sign of strength confirms the uptrend, and the backing up action confirms the change of character. So anything around this area where we could identify a potential C in a smaller trading range, that's number one. Where we see the breakout, that's number two. Where we see a smaller backing up action, that's number three. Where we see another breakout, that's number four. And it also presents a short-term weakness after this rally. So therefore, it acts as the final confirmation, especially on the breakout right here, of what's to follow. So I want you to think about this for a second. Why is this so important? Well, because usually students come and they say, well, I want to invest here in phase C. Could you teach me to invest here? And I usually say, yes, I can. But before you learn how to do this, can you at least start identifying these spots to me? Where you have a very high level of confidence that there's going to be a continuation. Once you can deal with that, could you identify to me in the middle of the sign of strength rally a point of entry there? Or maybe a point of entry on the last point of support in phase C or even or D. And only after that, go for phase C. So it has to be sequential, the way how you educate yourself. Because the mind is always going to be egoic. Our minds are always going to be based on the fear and greed. And here we will be thinking about greed. We would want to go in to establish the position at the bottom. But in a way, it's not even greed. It's still fear-based behavior. Why? Well, because if we're thinking about establishing the position at the lows of phase C, we're basically saying, I'm fearful that the price will go low from here. I always want the price to go higher. So fear is an extremely strong emotion for us, humans. And a lot of the survival mechanisms are built around fear, and our trading, unfortunately, built around those surviving mechanisms. So fear is going to be very, very dominant. Now, there was one comment here, which I really liked from Adam. Adam said that the high probability place to open the position is going to be in mid-October, somewhere here, which is based, I believe, Adam said, high volume signature. So disregarding even the volume signature, which we will discuss in the second month, this is a correct place to think about the point of entry. This is not necessarily the highest probability place, and that's the only caveat that I would add to Adam's remark, but it's still one of the points of entry that we will be discussing in this course. It comes after phase C. It shows to us a short-term ability of the rally to come to the previous local resistance. And look how flat this trading range is, this reaction is. It doesn't come to the level of the support. It's all flat. And obviously, we could talk about the volume signature here, but maybe not for now. Not only that, on the relative strength ratio line, which basically shows the leadership of the stock relative to the market, we're seeing that the breakout produced also a breakout in the leadership, which is a confirming sign as well. And we will study that in the third month, when we'll talk about the relative and comparative performance. So all of the points of entries are going to be talked about, guys, so don't worry about that. All of the confirmations are going to be talked about. It's just a lot of material, and obviously I can't give it to you right away, so we'll see how it's going to unfold. So after the first rally into the major sign of strength, we're seeing a reaction, and hopefully, guys, you could see this. I'm going to put the color here, blue color. This is the reaction that we're seeing. So for the first time in this rally, since the lows in the potential phase C, we're seeing the reaction that is outperforming all of the reactions to the downside. We see how this reaction increases in distance. You don't see it here, but I'm quite positive that with that increase in distance, the down spread has increased as well. And we're seeing, maybe a slight increase of the supply here. It's actually not that pronounced. So it's more over the latest reaction. Actually, supply level is kind of the same as other reactions, which tells us what? Here is, kind of like a preview on phase A bias identification, phase A bias. So what would we be thinking about the bias in phase A? Well, because the supply is at the same level or somewhat low and doesn't produce, an extreme move to the downside, we don't actually go to even one half of the move that we've done. We probably would be thinking that the bias is still going to be a reaccumulation at this point. And that's the way how I'm going to teach you guys. Your first assumption about a reconsolidation or a stepping stone trading range is always going to be the bias that you've defined in the trading range itself and the trend that we have had. So therefore, a bias to the upside and therefore a reaccumulation. And then we would be seeking confirmations throughout the range. And either we're going to confirm that this is a reaccumulation or we're going to reject this as an idea. So all of these elements here, just on the price alone, suggest that we're going to go into a trading range. By the way, now that I've talked about the bias, let me talk really quickly about the duration. This could be just a preview of what's ahead for those of you who's going to kind of graduate to more advanced level. Think about the increase of the supply. Is it a lot of supply or not a lot of supply that comes in on this change of character? Probably not, right? So increases, but not substantially. So what could we say about the level of the supply? The level of supply is average. So therefore, we are not expecting that the duration of this trading range is going to be big. It's not going to take a lot of time to absorb whatever supply is coming. So duration is probably going to be not that long. And we see that on the next, attempt to go down, there is a test which looks like phase C, sign of strength, backing up action, and off we go to the next change of character, which is somewhat hard to see here, but if we would be thinking about the rally into the sign of strength, comparing it to the previous rally, we would see that it's much better as a rally in this trading range, that the reaction is more horizontal, so that suggests a change of character. And within the context of the previous range, which we thought was a reaccumulation range, and then the context of the uptrend, we are saying that the change of character acts as a resumption of uptrend. Why is this significant? Well, because this is where we're going to originate our positions. This resumption of the trend, of the uptrend, gives us a timing. It's a timing tool to consider that now is the time to go in and open the position. In the assumption, it was an assumption that there's going to be a continuation of the swing or continuation of the longer term trend. Okay, well, imagine that we've opened the position. And imagine that we open two positions. One is a swing position and one is a long-term long position, kind of like investment position, right? Or, we're just trying to catch a much larger swing. Our entries are going to be here, 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 and here. 4 points of entry on the way up. And then as we go through the uptrend, we see the break of that uptrend, and then we look at the reaction. And it's a little bit complex. It has ABC formation, or 1, 2, 3. For those of you who are familiar with Elliott wave, you will recognize this reaction. So look at this reaction and compare this reaction to every reaction that came before. What do you see? Well, I see that we're definitely overshooting, the distance with which the price travels to the downside. So this becomes the largest distance. Again, downward spread is increasing. We could see maybe some increase in the supply as well over the previous reactions, so the latest reactions, but it's not as significant. And again, we probably are thinking here that this is a reaccumulation. If distribution would come, it probably would look differently. Supply would be more violent and the price action would be more violent to the downside. We don't see that here. But we are concerned with this slightly lower low. Now, what happens next is so amazing because the next rally suggests a sign of strength being followed by the backing up action. And if we would look at all of the rallies in this trading range that precede, we could say that this is the largest rally. So therefore, the price behaves differently. And we want to acknowledge that, and we want to say that this looks like a change of character. And then the backing up action confirms that. So here we're thinking if this is a change of character, again, this is the timing for us to find points of entry in this area as our assumption about the trend is such that the uptrend will be resumed again. So if we are swing traders, our tactics are going to be such that most likely we're going to be exiting somewhere here. This is our last point where we're going to give up our position. And this is going to act as kind of like this local capitulation. And as we're closing the position on that particular bar, we will be a part of that capitulation. We still will have a really great trade. This is the trade right here. And for a swing trader, that could be a great trade. Later on in the course, I will show you, or rather in the practicum, I will show you how to identify this action as a potential point of exit. This is all going to be associated with the climactic run into the stopping action of the buying climax. And I'll outline to you the spots where we're going to be exiting the position or scaling out of the position. But for the long-term investor, we still would stay in this position. There is, if the initial bias in phase A based on the supply signature suggests that this is still reaccumulation, then we want to stay in this position. Actually, we want to add to the position, and we will be really heavily adding here and then somewhere here on the breakout. So these are the two spots of short-term weakness in the context of a much larger trend, long-term uptrend, that we will be looking for the long-term investor to add to the position, and for the short-term swing trader to establish the position for the next swing. Now, couple of you, before the class, were talking about, yourselves. And by the way, guys, could you please email me like one paragraph on who you are as a trader, what do you trade, and then what kind of history was the Wyckoff method you have, and also how did you hear about our course? Just let me know the source. I would really appreciate this, and send that with your homework. Don't send this as a separate email. Or if you want to send it as a separate email, that's fine as well. A couple of you identified yourselves as long-term investors, and the question about the course was, well, is it going to be helpful to me? Well, hopefully, even from this picture, you kind of could see that it should be extremely helpful, because we will be discussing, obviously, original accumulations, but here, in the trend itself, how do you decide, are you still staying in this position as a long-term investor or not? Where potentially could you add to the position? Those are also very crucial places. And then where do you actually exit? So look at the next change of character that comes. It seems like all of the reactions here, which is 1 and 2, are of the same magnitude. And then suddenly we have such a huge reaction to the downside. This is by far the largest reaction, not only on the last leg up, but actually since the lows in the potential phase C here. And not only, when we look at this reaction, we would be thinking, okay, well, is the trend done? Is the uptrend done? And at this point of time, because it's a much more substantial reaction than what we've seen before, we probably would conclude or make, a couple of deductions here. Our first deduction is going to be that, well, first of all, after the change of character, we're definitely going to experience a non-trending environment. That's number one. Secondly, because of the size of the change of character, we're probably going to say that that trading range is going to increase the duration than anything what we've seen before. So therefore, the timing comes in as an element of our analysis. So this is not necessarily in the methodology. This is something that I've developed with the advanced students in the practicum, just addressing exactly this question. What about the duration of the trading range? So, and it's not necessarily common knowledge. I know that Bruce does not use this. I know that other, Wyckoff experts do not actually use this, but it's a very hard, evidence, that we see even on this slide alone, to make some kind of assumption or judgment about the duration. The smaller the change of character, the smaller the duration of the range. The larger the change of character, or the larger the presence of the supply, the longer it takes time to absorb the supply. So therefore, duration of the range is going to increase. Okay, what other assumptions could we make here? Well, obviously, assumption on the bias is going to be something of interest to everyone here. But at this point of time, we would just have to say that it looks like the selling has come, but it's not, extremely heavy. We're still going to be under the initial assumption that this is a reaccumulation. And then we either going to confirm it through the price action in phases B, C, and D, or we're just going to reverse our bias, and this bias, original bias, which is to the upside, is going to fail. And then with this failure, we're going to say that most likely we're in the distribution. So this has to be, confirmed as well as we go through the whole trading range. Okay. Well, hopefully this is simple and understandable in terms of the first major concept that we want to work with. Change of character, again, is an extremely important concept, and that's why I'm teaching this concept first. I did not even talk about, let's say, accumulation or distribution in general. Let's look quickly at another example here. Excuse me. Need my water. We are, again, talking about Yahoo, and this is a daily chart. 2002, 2003 lows as a trading range, and then look at how the first momentum lag is identifying urgent buying by institutions. And those are predominantly trend followers. And then look at the backing up action here. It's not just flat, it's actually sloping up. So there is a lot of structural strength in this reaction by itself. And it happens on the background where supply is the lowest supply within the whole range. So that was a really good trade right there, or a point of entry. And by the way, for those of you who are extremely picky about, all of this stuff, and which I want you guys to be, because I am the same way. You might be saying, okay, well, where is this sign of strength? If you're talking about the change of character, like this is a change of character, but where is that sign of strength that should overcome the point of the resistance? Well, you're looking at this in a slightly different way. So look at the lower high, lower low. So what does this look like? This looks more like a triangle. So the backing up action actually comes exactly to the point of that sloping down resistance, and therefore, it's all in line with the sign of strength and the backing up action. This characteristic we will study later. Characteristics of apex and what kind of sign of strength and the backing up action there we could expect. As the price goes up, look at the texture of all of the moves up and the reactionary textures. So reactions are either flat or non-significant. And then the moves to the upside have some kind of deterioration of the momentum. So we have first a lot of momentum off the low, then continuation of that momentum. We still see some buying here in this area, so that's great on the way up. And this is how institutions, trend following institutions, are getting into the position. They're assessing at this point of time, the bias, the value proposition that they have, the liquidity that is available to them at this point of time. And because they are already late to establish a position at the level of support, what they are going to do here is they're going to be buying on the way up. And this buying on the way up is going to look like this. So obviously this is buying off the low, and also we could say buying on the way up by itself. But after the first initial momentum buy by institutions, this is what we're going to see. So there's going to be fewer institutions, that's number one. Secondly, this buying is going to be on the way up, so it's going to push the price up. And as we understand these concepts of the initial momentum buying and then just continuation of this buying throughout the trend, then we could see that momentum on the next rallies is fading. And we don't see as much buying behind, those waves. So we could expect some kind of stop-in action, buy-in climax, and then a change of character. So how would the change of character look like? Well, obviously it's going to look different from what we've seen before, from the reactions that we've seen before. Look at those. Do you see how different the latest reaction is? So right away, we are noticing that, we are making a note here, and at this point, we are going to say, we're going to make a couple of deductions. Change of character, and here also a small break of trend as a confirmation of that. It means that it's going to be a trading range. We don't necessarily see a lot of volume signature that is different on the reaction. So we're going to assume at this point that the bias is still up. And again, remember what I said. Don't take only these words from me. That the first thought is going to be, oh, it's the same bias as the trend before, just because supply is not there. We need either to confirm or reverse our bias as we go through the range. And the reversal of the bias could happen many times, in a lot of stocks, because it's not always there's going to be some kind of continuation, of the previous trend. So at least here, what we could deduct, is that we've experienced the buying climax, a change of character, and therefore an automatic response or automatic reaction in this case. And we could form a trading range by applying the parallel lines to the buying climax, and this is going to be our resistance, and support, which is going to be defined by the law of the automatic reaction. Our next assumption is going to be by Wyckofian structure. We're going to ask ourselves a question. What comes next? Well, obviously, if there was a climactic stop in action, there is still going to be some momentum to the upside that we need to check. Right? So we're expecting a secondary test in phase A. And as we've talked about secondary test to the sell-in climax, that there are three types. We also think that there could be the same situation for a distribution where we could say that buy-in climax is going to define the point of resistance, and then we could have a secondary test that's going to have a higher high, or a secondary test that is going to have a lower high, or a secondary test that is going to be kind of on the same level or close to that of the buy-in climax. So the same structural options on both accumulation and the distribution. So, and you kind of could see, guys, already where I'm leading you with this. If you understand Wyckoff context, if you understand what I call Wyckoff layer on the analysis, on the structural analysis of the conventional technical analysis, you could anticipate things, the way how they should unfold, the character of those things to come, and more importantly, to understand, should I be trading in this environment or not? And if I'm trading, you should be understanding how you should be trading. So for instance, if I have been in this position and I'm a swing trader, then my decision making here is going to be very simple. I'm just basically looking for the points of exit. I could exit on the way up into the climactic action. I could exit on the change of character bar. I could exit on the change of character reaction. I could exit on the way up into this secondary test rally. There are quite a few spots to exit that we will be discussing as a part of this course. If I am a long-term investor, I'm still in this position. I still need to go through the whole trading range to define the potential bias and either to confirm that bias or to reverse this bias and therefore start scaling out. If if I am a short-term trader and I'm not in this position, and I'm looking at this potential phase A as it unfolds, and I look at this change of character, I'm saying there is no swing opportunity for me here. This is just phase A. I still have to go through phase B and then phase C, and to define that bias, going into phase C. So I will not be participating, as a swing trader in anything what's unfolding right now. Having said this, a much shorter swing trader might be thinking, okay, well, I see that we've experienced automatic reaction. I'm looking for the secondary test. I see that supply is somewhat the same than at other spots, other reactions, and that the initial change of character actually was not that pronounced. So as we're experiencing a secondary test, most likely this test is going to be strong and therefore a higher high and will create probably some kind of upthrust opportunity. So how do I trade that? Well, I want to establish position here somewhere on the intraday basis and then trade through the resistance. And once I see first intraday signs of distribution, I will be out. But again, this is somebody who's going to trade on the intraday level, on the very, very short-term swing trading level. So in here, I went through all of the possible, traders and their requirements as to how they would be thinking about the Wyckoff structure at this spot. Well, let's see what happens next. So we said that supply was not that impressive, and then the change of character was not that impressive either, relative to this whole move. So most likely the secondary test rally is going to produce some kind of upthrust situation with the higher high. So that was great. We were correct on that. But we know by the Wyckoff context, by the Wyckoff layer and structure, that phase A is going to conclude with this secondary test, and we're going to go into a very volatile and predictable phase B. As we go through this phase, and here is my honesty and authenticity and my commitment to all of you guys, and more importantly, even to myself. And for those of you who know me for a while, and I see that some of you guys here are alumni, first of all, great to see you here. Great to have you in the class. Don't forget to give me some feedback as you've listened to me and to this course, maybe a year ago, maybe 2, maybe 3 years ago, maybe even more than that. Let me know how the course has improved and how else we could improve the course. I'll be very curious to hear. But my commitment to you guys is of the highest honesty. I'm going to tell you exactly how I'm conducting my trades. I will not hide my losses. I will not hide my mistakes. It is not my intent to do so. So when I say something, usually take it for what it is. Usually this is how I think, and this is the most honest answer that you could get from me. So looking into phase B environment and looking at the higher lows, I still, as a long-term investor, would be thinking that the bias here is to the upside. There is really nothing distributional about this pattern in phase B. Nothing. You don't have a lot of supply coming in. It's somewhat mediocre, average. and it doesn't produce, anything larger than the change of character, which is by itself is not such a, big retracements from the lows to the highs of the buying climax, from the lows of phase C into the buying climax high. So I'm still going to be thinking that this is a potential reaccumulation at this point. The only question here is just the timing. Are we in phase B or in phase C? If we're thinking in phase C, then we should wait. If if we're in phase B, then we should wait. If we're thinking that we are in phase C, then you're going to originate a trade somewhere here. And your point of exit is going to be this bar right here. So basically, you're going to have a break-even trade. Again, this is something that I don't mind for my own trading and for the trading of my students. What this trade does, it creates two levels of understanding. The failure of this trade creates two levels of understanding. The first one is going to be that the analysis is actually incorrect. And it doesn't matter whether the analysis is incorrect because it didn't really show us what it's going to be in the trading range itself. Sometimes the bias is so evident, even in phase A, you can't really think anything else. But then in some instances like this one, you're going to see a lot of elements of outperformance like Yahoo was exhibiting in 2005 in phase B and phase C, and you might not distinguish this as a potential distribution. In the first class, in the first lecture, I have shown you an actual trade in Novadear that I did just recently, where Novadear as a leadership stock was exhibiting elements of reaccumulation in what turned out to be, a distribution. The same here with this stock, with the same with Yahoo. Why is this happening? Well, because there is a lot of leadership characteristics on the way up, and they are not going away really fast in the trading range that turns out to be a distribution. So therefore, a trade like this, the one that I'm showing you here, is actually an okay trade. If you're not okay with this trade, then you are greedy, and something you gotta check with your ego, because we never 100% right in this craft. Trading is not about being right, all the times. Trading is about making money. There are no other goals, there are no other intentions but to make money. If you're spending time on this, you should be making money. If you're not making money, then you should make some kind of adjustment. Get more knowledge, get more skill, and develop that skill. All right, so as we go along this range, so what else do we see? We see an upthrust and then a failure. So it's right here on this failure of the upthrust. This is where we're gonna start thinking like, what is going on? Look how supply is starting to show the picture of the distribution where supply is starting to increase. There is a lot of selling off the top. So usually that type of selling is always going to be institutional. So we might be thinking here that with the increase of the supply and the way how the price quickly reacts back into the trading range, we might be in some kind of either short-term distribution or in the much bigger distribution. So a short-term distribution would take us to the support level and maybe even below that level. And then that could be a trade by itself. You can establish a position somewhere here on the failed signal and then continue with this position until you see some kind of lower low. So exit here or somewhere here would be okay. And then you could wait. You don't necessarily have to continue with the short trade here. You could wait and you could see how the last point of supply is going to unfold. Or is it going to be possibly a spring? Because in some of the cases, we could have volatility going into phase C of the reaccumulation and then a move to the upside. So That's why we would want to wait and to see if there's going to be some kind of further failure and further behavior that is going to be associated with the distribution. Well, we talked about the changes of character, and that's the main topic today. Um, Look at this reaction to the downside. Compare that to the reaction that we've seen throughout this whole trading range. Is it expanded? Yes. Is the down spread expanding as well relative to what we've seen in the current environment? And we see that those are the big spreads. The only spreads like this we've seen on the change of character itself. So that tells us that we definitely seeing some bearish characteristics here. Would the volume signature increase? Yes. Would the supply signature increase with that? Yes, absolutely. So we see in here a synchronicity, and this is just again, a WTC word, synchronicity between the downward effort, which is expanding, and the downward result, which is expanding as well. Therefore, the bias, at least short term, at this point, is going to be bearish. So, and please note again, let's be honest about where we define the bias. And let's be honest about even questioning where we're defining the bias. If you're going to say that, why are you not define the bias before, let's say, the beginning of 2006? I'm going to honestly answer you that I did, and my bias back then was still to the upside in this area until it actually showed a failure. And this is where my bias has changed. And there is nothing wrong about changing your bias as long as you understand why and as long as you could use it and make money. So just something like, as we go through the material, guys, I'm giving you my belief systems about trading and about money as well. And you should make those notes somewhere. And just in general, a piece of advice, for those of you who are seriously studying this course, for those of you who are going to be spending, hours on homework, I'm going to push you a little bit more. And I'm going to say that your main homework should be not just labeling the charts that I'm going to give you, but it also should be making notes, listening to the recording again and making notes and sending those notes to me. What that does is, as you could see, I go through the material somewhat fast, and I'm giving you a lot of material. Yes, this material is being repeated over and over, but still, I'm giving you a lot of material. Our minds are just not capable of absorbing all of the material at the same time. That's what I've seen from students from cycle to cycle to cycle. It's not just you, it's very common. I cannot absorb all of this material, even of this session, like if it would be a new material to me. So therefore, watch the recording again, make notes, send those notes to me. So let's come back. So we clearly see some bearish activity on the possible change of character. We're assuming that this is a sign of weakness and that the next rally, which is not going to be extremely strong, is going to be a last point of supply rally. We're looking for the points of confirmation of this information, and this last bar actually gives us exactly that. By itself, this rally into as a last point of supply rally is better than any of the rallies that we have seen on the change of character. So therefore, we might be even thinking that there could be another trading range here before we continue to the downside with the bias, with the overall bias that started with the upthrust here. So therefore, we could be either entering a position right here. This could be our point of entry, but the very vibrant rally suggests that demand is there, and this demand is probably of weak hands, but increase of the demand as increase of the supply will always have to have some kind of test or retest. So we are thinking that maybe there's going to be some kind of test again at this level, And there's going to be another point of entry for us here. Okay, well, let's see what has happened. Ooh, and I don't have this. How come? Okay, apologies. So if I remember this correctly, and you guys could check out on Yahoo. I think it's been discontinued, but still, I believe we had some kind of trading range here, and then we went to the downside. So that was the history. Okay. All right. So important concept on the change of character. Uh, if you did not fully understand it, please rewind the recording, listen to the recording again, stop at the spots that you don't understand, rewind it, listen to it again. If you don't understand still and have a question, email me and we'll just go from there. Okay, all right. Let's talk about accumulation. So that's the next question for us, right? Because as we think about a change of character, which is basically, from, let's say, an accumulation, a downtrend changing into the non-trending environment, into the trading range. As we enter the trading range in phase A, the biggest question from students, and it's just funny how it is, I would actually never be thinking about this question because there are so many things that are going to still unfold as consolidation unfolds by itself. But that question is always about the bias. So students always want to know what is the bias. Um, Again, as I mentioned before, the advanced studies, which we're going to do, in the practicum course, are going to address this question to a certain degree, not necessarily to the fullest degree, but to a certain degree. But for now, what I want you to do is just to think of a change of character as a change of the environment. And then once we're in the trading range, that's when we want to observe how it unfolds, and we want to solve this problem of the bias, the timing, when the price is getting out, so therefore identifying phase C and D correctly, and then the character. And usually the character is going to be all about the leadership and the way how the price is going to travel, what kind of structure it's going to give us. So how would we do this? How would we define accumulation? Well, there are a couple of things that are going to help us out. The first helpful thing that Wyckoff method, and this is the value of the Wyckoff methodology, by the way. I was talking to Bruce the other day, and I was telling him that if you think about the Wyckoff method, all of the elements, the most important concepts are all on the level of price structural analysis. Everything else is just more in depth on the technical analysis concepts, and I recognize it could be more in depth. Let's say when we talk about the volume, I meet very rarely people who don't know about Wyckoff and they talk about the volume on a very high level. But majority of volume guys are going to be all about, some kind of Wyckoff background. But predominantly it's all about, the structure and how it unfolds. So we'll talk about the phase analysis. And phase analysis is extremely important because phase analysis gives us the timing. It gives us to a certain degree the bias as well. But more importantly, it guides us through the process of how trading range unfolds. And we know that a specific phase is going to have specific Wyckoff elements, specific Wyckoff events, and those Wyckoff events are going to unfold in a specific way, And that could give us a hint for the bias as well. So what do I mean by that? What do I mean by this phase analysis and how everything happens kind of in the same way? Well, let's talk about phases, and let's start with phase A. And we spent some time already on phase A. We said that um, in phase A, we have the conclusion of the previous trending environment, in this case, a downtrend. And it's going to conclude with 4 points. The first one is going to be always failed attempt to stop the price from moving further down, and it's going to be our preliminary support. So here's on this slide something that I want you not only to read, but I want you to remember. I want you to memorize this, to the majority of it at least. I want you to memorize this sequence of events that are going to come in the trading range. This is one of the mistakes that students make a lot. So I want you to understand that first is going to be preliminary support. That's going to be followed by the sell-in climax. That's going to be followed by the automatic rally, then secondary test, and so on and so forth, from one phase to another. I want you to remember this sequence of events, how trading range unfolds. Coming to phase A. Coming back to phase A. Preliminary support is the first attempt to stop the price from moving further down. And usually, this is still going to be an institutional activity and some institutional buying. Institutions at this point of time already seeing some kind of value, and some of them just a little bit more premature entering the position, which is totally fine with them because their time horizon is so, long and big that even if they bought here and they sold somewhere here, this is still a profitable trade for them. Also, please think that there could be scaling in into this, and they could buy more at the selling climax and kind of average down, and then turn out to be averaging about 1/2 of the trading range or even below that. So quite a few different ways of how institutions could start accumulate, and preliminary support is going to be one of those initial first points where institutions could establish a position. Then this preliminary support definitely going to fail. Preliminary support, preliminary supply points will always fail. You will always see either a lower low for the selling climax or a higher highs for the buying climax. If you are labeling it as a preliminary support, which is the lowest point on the chart like this is wrong. So this is incorrect right away. So selling climax is going to come, as I mentioned, as that panic from weak hands. And again, weak hands at this point, and this is more of the general capitulation. So at this point, weak hands are not just public. And this is what's been taught to us, that weak hands are going to be public. No, that's not correct. Get this out of your head, especially those of you who've been studying the methodology for years and years. Weak hands are not necessarily just public. Weak hands are always going to be public plus institutions. Otherwise, we would not have such a huge volume signature on the selling climax. Public cannot produce, overextended volume spikes like that. So on this general capitulation, the volume signature is going to increase dramatically. Supply is going to increase dramatically. Demand is going to increase as well. And that increase of the demand, that's what's going to start absorbing the supply. This is initial absorption. And who's absorbing? CO, composite operator, composite man. And then as this absorption happens, initial stopping action happens. And this stopping could be having such different variations. Momentum could slow down, but price could still go down at the same time. You could have situations where, let's say, there is a deterioration of the supply, price still goes down. You could have a stop in action by itself where you have a spread that is decreasing by the spread, daily spread, and it's decreasing significantly. At the same time, the volume signature is spiking up. So what does it mean? That means that there is a force that pushes the price down, and there is a force that pushes the price up. So supply and demand increases at the same time, volume signature increases dramatically, but yet there is no progress. The result is kind of the same. So that is a stop in action. And then, another one on the increase of the demand, you could start seeing the price actually not just stopping, but start moving up. So that's the whole process behind the selling climax. Again, obviously, the most interesting part about this is the exchange of shares between weak hands and strong hands at this point of time. Both groups have different intentions. One group wants to get rid of the position because the emotional pain is too much. Another group is trying to establish the meaningful position because there is a point of liquidity and value to them. All right. After the selling climax, as the supply is being observed, that produces automatic response, which has not just the buying by institutions on the way up, but short covering by professionals that pushes the price up. And that establishes a change of character and establishes the high for automatic rally, the low of selling climax, and therefore establishes the boundaries for the trading range itself, establishes the resistance and the support lines. This is a very valuable piece of information. Actually, I've given you today so many great tools on how to think about the change of environment and how to establish the trading range and how your decision making at those spots are going to be tested by all of these events. So I want you to understand all of this. I want you to memorize all of this because as we go along and we're going to go into much deeper stuff, especially with supply and demand, I want you to think about the definitions. I want you to know them. So very valuable information with the resistance and the support lines. Why? Well, because for the majority of the duration of the trading range, this is where the price is going to reside. It's going to have some points where it's going to go into the oversold condition or overbought condition, and it's going to create low lows, high highs, but that's not that important. The majority of the deviation of the price is going to be still around the mean that was created by that phase A. You might have some slope to the upside, to the downside, but predominantly it's going to be horizontal. So therefore, think about the trading strategies that you're going to have here. If you're an option trader, your strategy is going to be collection of options and very short duration kind of weekly options type of directional trades. If you're a long-term investor, your goal is here to identify the bias of the whole formation and timing, identifying phase C and phase D as your potential points of entry on the emergence of the trend. If you're a swing trader, then most likely this is not even going to be the best candidate for you even to be in. But if you're a very, very short-term trader or just oriented for this specific stock, then you could have some directional trades. And those should be originated at the points of resistance and support, so around the edges of the range. All right. So as we conclude our phase A with secondary test, which is again a local test of the climactic action, it basically asks a question: do we still have a lot of supply left from the downtrend and the last leg in this downtrend, the capitulation into the selling climax? And if we don't see that continuation, and we see the reversal, then it confirms a change of character by itself. It confirms the idea that we are in the trading range. And we also will start thinking about phase B and how that phase should unfold. We will be talking about the intentions of the trading range, of the phases in the trading range. And that is also something that I want you to remember by heart. The intention behind phase A is all about stopping the previous trend. In the accumulation, you will be stopping the downtrend. In the distribution, you will be stopping an uptrend. And therefore, the intention is just to stop the previous trend. In phase B, we're doing two things. We're building a cause, and building of a cause happens because there are so many fluctuations in phase B that we could observe. And those fluctuations are just a kind of reflection of buying and selling by different groups. And through this buying and selling, what is happening in phase B in the accumulation, it's the further process of absorption of the supply that is going on, that is happening here. And it's not going to be extremely visible. And again, this is something that I'm going to be extremely honest with all of you guys. This is not a linear craft. This is not a linear analysis. This is something that it only could become linear if you understand all of the variables. And unfortunately, we can't even comprehend the number of variables that influence the movement of the price of a single stock. But what we could comprehend is the way of how patterns should unfold. And we're obviously saying the pattern will unfold with different variations. And those different variations is going to create different structures, and we have to make sure that we understand the process with which the trading range is going to unfold. So in phase B, there's going to be still in accumulation that process of absorption that is not going to be extremely visible to us. In some instances, it's going to be extremely visible. We might have some, elements of strength, let's say, as a sign of strength, and we're going to say this is a minor sign of strength, and it acts as an upthrust action in the possible accumulation. And then we're going to see a very laborious move to the downside in phase C, maybe into the higher low as a last point of support rather than a sprint with the lower low or a shakeout. So those are going to be extremely visible to us. But in some instances, they will not be. And what we will have to do is we will have to make the best judgment in phase B and then look into phase C and D as a confirmation for that bias. And this is as honest as I could be with you. And one more thing that I'm going to say here. You will make the mistakes making that judgment call, and that's okay. You make the mistake, you post-analyze this, you understand, was this an analytical mistake or systematic mistake, or was it a trader mistake, my mistake? And then you address that. You make an adjustment. If there's something new on the analysis part, you take that chart, put this in your library, you bring this chart to me, we discuss this in, either in session number 15 or in the practicum or somewhere else, and we'll understand it better. But those things will happen. So phase B also, as I said, building cause through this buying and selling waves, and then it's all about the supply and demand. Is there absorption happening, or maybe supply is very dormant, but the quality of the demand is not there. So what does that suggest? Probably suggest a continuation rather than a reversal. So again, something that we will be discussing and practicing and developing the skill to recognize. Then we go into phase C. And phase C is the most important phase in the whole trading range for me. Why? Well, because it's the last test at the level of the support for accumulation and reaccumulation. And what is it testing? Well, obviously, it's testing the availability of the supply. It's testing the availability of the demand and the quality of the demand at the support level. And if we would be just thinking about the testing of the previous price action, then the test is definitely oriented toward testing the support in phase B and toward testing of the support in phase A. We want to see if the price not only can commit to the downside, and I'm not talking about the temporary commitment where we have one or two closes below the support level and then instant resumption, of the upswing. No, I'm talking about a more meaningful commitment to the downside. Ironically, the current market shows a lot of those spots where there is, a significant commitment to the downside, and yet even that could act as a shakeout. And we kind of seen how the market is reacting. Uh, in the mornings, the behavior is always sell, and then into the close, even today, into the close, we're seeing some kind of move up. So whatever supply comes in on the discounted news from overnight or from over the weekend, it's still, some buying that is present there. We are at the very kind of like interesting spot where we could have a reaction, but we also, if the price action is going to be more bullish, we could continue with that move to the upside, or we could have a very shallow reaction. So we'll just have to see. But phase C is that last test at the level of the support. This is the test of the supply and the test of the demand at the same time. And this is a test number 3. I will come back to this idea. And this is a pure Romanism. That's how students call this. Because in the original course or GGU course, or whoever you took this course before, there is no mention of this. But I wanted to create some kind of shortcuts for you guys in order for us to just understand the concepts. And I will develop, the idea of why test number 3 later on. But for now, I want you to remember that the first test is going to be a local test of the climactic action to the selling climax. That's test number 1. That's in phase A. The test number 2 is going to be the test of the support area in phase B. And then test number 3 at the support level is going to be the test of the last point of support, the test of the sprint, the test of the shakeout. And it's still going to provide us the clue that even if supply is available here at the spot, demand is capable of reversing the price back into the trading range and then pushing the price back to the resistance point. Our fourth test is going to be a backing up action. And this test is going to be at the level of support, but at the different level of support. This level of support is going to be all about a conversion, a switch from resistance to the support. And that test number 4 is going to confirm a change of character. Okay, well, if phase C is the last test, and it's extremely important to observe this test of the supply and demand at the support level and to seek the confirmation that the price comes back into the trading range and has characteristics of being able to move the price up on the bullish volume character, the bullish price character, and so on and so forth, then phase D already becomes a part of the markup phase or an uptrend. And usually when we look at the historic chart and you need to quickly identify phase C, what do? You look for the lowest point in an uptrend, and usually that's going to be your phase C. That's going to be a shortcut as well, and especially for the homework that I'm going to give you guys. So phase D is a part of the uptrend already. And in the uptrend, the behavior is going to be different. And we're going to experience that change of character again. As I mentioned before, the rally is going to be the best rally out of all of the rallies in the range, and then the reaction is going to be the best reaction in the range. And in a lot of cases, it's going to be more horizontal than the reactions in the trading range itself. And then after that, as we confirm the uptrend with the breakout out of this area of the sign of strength and the backing up action, that's when we enter phase E. And this is where it seems, or at least that's what we were taught, things are going to be easier. Not necessarily the case. The character with which the price moves could become very dull, uninteresting, and you could regret this trade. That's number one. Secondly, even in the uptrends, we're going to encounter a lot of consolidations. And we still have to go through the same process of identifying, the buys and Wyckoff events, phases, and so on and so forth. Some last thoughts on this slide. First of all, I want you to read all of this. This is your homework. So read all of this. Then try to find all of these points on the schematic. And then also, as you read through this, I want you to identify certain characteristics that are going to be useful in identification of all of these Wyckoff events. What do I mean by that? Well, for instance, an event like selling climax is going to be associated with the increasing momentum to the downside, increasing downward spread, increasing volume signature, increasing supply signature. Automatic rally might have the increase of the demand and increase of the upspread behind it. Secondary test is going to see the diminishing downward spread and diminishing volume signature, and specifically diminishing supply signature. Spring as well as a shakeout will have a structural lower low, and then we'll study the sprints. Sprints are going to have different levels of supply and price penetration below the support, and specific failures, like sprint number one. And then a shakeout is going to have characteristics where the volume signature is going to increase a lot, and there's going to be a lot of commitment by the price below the support. And it's going to look a lot like a sign of weakness. So the biggest question here is going to be to decipher whether we are in the bullish or bearish bias. Sign of strength is going to have characteristics where the upspread is increasing, where the volume signature in general is increasing, and therefore demand is increasing as well. In a lot of cases, when I'm going to ask you what is the definition of the sign of strength, you're going to give me the incorrect definition, and instead you're going to talk about the character of the sign of strength bar. A sign of strength rally is a different beast than a sign of strength bar on that rally, and usually students are giving me the character of the sign of strength bar, not even the definition of the sign of strength bar. So I want to point this to your attention. So, and then the backing up action is going to have characteristics where the down spread is decreasing, where the supply signature is decreasing, volume signature is decreasing, and so on and so forth. So as you could see, each Wyckoff event has some specific characteristics, whether those are price characteristics, volume characteristics, or contextual characteristics as to where those events are going to happen at the level of support, at the level of resistance, in phases A, B, C, or D. And what it does to us, once you understand all of this, once you get all of this, is that it acts as a roadmap for us, not just for the timing when the price is leaving the trading range, but for the bias as well. You might be thinking, oh, okay, well, shakeout looks like sign of weakness, so it's a bearish bias, but then the price quickly comes back into the trading range, shows some bullish characteristics. Would you change your bias then? You should. And that's why Wyckoff methodology is so great, just because it gives you that contextual layer that you could apply to your analysis. And that layer is not only for the price structure itself. That layer could be used for supply and demand characteristics, and that's why supply and demand is so huge in Wyckoff analysis. It could be used for the relative comparative purposes and comparisons. And more importantly, it will be used by us with tactics. Tactically, we want to understand that the best phases for us are C and D, so identification of those phases are going to be crucial. That's number one. Secondly, we could bring, into with tactics a lot of the structural events type of interpretations where we could open the position on the spring itself, on the test of the spring, on the breakout of the local spring, on the sign of strength bar, on the reversal of the backing up action, and on the breakout. I just went really quickly through all of the points of entry that we will be discussing, and we will be discussing those in more details as to where exactly, is it at the open of the bar, at the end of the at the close of the bar, how would we use intraday, and so on and so forth. So that's all we had. So I want you to understand all of this. So you need to read all of this. You need to memorize this. You need to understand the characteristics behind each event. Okay. And, I've talked about the different type of variations on how, let's say, an accumulation absorption could happen. Let's imagine that there is a lot of value in the climactic action for the stock that has just very, very, big move to the downside, and selling climax becomes the lowest low in this whole range. How is it possible? Why would this structure be created instead of a more horizontal, more conventional structure that we see here on schematic number one? Well, we can think about this, right? So there is a lot of value, and not only a lot of value, this is an extreme value for institutions. They're just saying, wow, the value of the stock is somewhere here, and now it's just so undervalued. So I'm definitely going to buy this because it's almost like a free trade to me at this point of time. Even if it consolidates and at some point it will come to the value zone, then I'm going to make money. So what they're doing here at this spot is they're buying a lot. And because they're buying a lot and they're willing to buy even more, because still at this point of at the higher low, there is still extreme value for them. And then at another higher low, there is still some value for them. So they're coming in and buying on each reaction and supporting the price. And that does not allow the price to go back to the support level and even create a lower low. So there is some urgency in the way how institutions accumulate in this particular pattern. And that's what creates this pattern, the upsloping structure. And that shows a potential leadership in the future. It's different than the conventional accumulation range where we would see the stopping of the downtrend with the buying from institutions, and then it's kind of flat. And the spring could be a lower low, the shakeout could be a lower low, but we could also have a higher low here as a last point of support. So why is it different? Again, different urgency to accumulate. In the conventional schematic, the urgency more as the price leaves the range. This is where the value becomes scarce. In institutions that are late, they are the ones that are going to push the price up. In the extra strength trading range, it's slightly different. Extreme value at the point of the climactic action, and then every time it gives a reaction, there is still some value. So They are pushing the price up, and that's what creates the structure. In the continuous weakness, where we have the lowest point as a sprint or a shakeout, and it's different than the conventional one, even though it's a low low as well. We kind of see that there is some kind of downsloping structure here. So lower lows throughout, and those are significant lower lows. What does it tell us? That even though initial accumulation has happened here on the selling climax, there is still supply present that pushes the price down. And then at the lower points now we see the value. And this is where institutions are accumulating. And that's how the structure is being created. The traditional sources are rounding up formation. Here the same thought. Even though selling climax is at the high level, still there is some elements of the supply that push the price lower, retesting it. And then until the last test is showing some kind of deterioration, we will be testing it, and we still will be looking at this as a downtrend. It's when the change of character happens, and then we start seeing this different behavior, higher highs, higher lows, and the volume signature is going to exhibit, this type of the behavior. That's when we're starting to think about this pattern as well. So again, I don't want you guys to be linear in your thinking about how we approach this analysis. You gotta be flexible. Your minds have to be dynamic. The only way how to behave linearly about this are two ways. Take just one small event, and there you can say, yes, this should unfold this way. And if it doesn't, then it's a failure, and I'm gonna trade it in a different way. And secondly, if you are capable of thinking, thousands of variables at the same time, then you can think linearly. If you could analyze so many data points, then you can think linearly. So what I would like you to do for your homework, going back to the previous slide, print it out, have it for your library of slides, have it in front of you as you do your homework, and use it for your homework as you start labeling. And then also look into this schematic right here, or schematics rather, and then print those out as well, and try to identify as you go through the homework as to what kind of range you have there. Is there extra strength or extra weakness? Is there, some kind of specific formation that, that you see in your homework? And that would be the best. All right. Reaccumulation. Yeah, let's go through the reaccumulation. This will be really helpful for the homework. And then we'll discuss the homework, and then we'll probably stop at this point. So usually I jump right into the distribution, but this cycle I decided that I'm going to go about this in a slightly different way. And you kind of see how I'm creating this sequence. So going from a change of character that basically tells us how the environment changes. So from the down environment to accumulation. This is the change that we've described, a change of character. And this is a change of character. And those are the spots where we're going to make majority of our trading decisions. In between, we said that we need our phase analysis to define the bias, timing, and next character. But once we're in the trend, we could also go into non-trending environment. And obviously, at this point of time, you would be thinking, is this a distribution or a reaccumulation? We're going to concentrate today on the reaccumulation, just concentrating on bullish patterns for now. So reaccumulation is different from accumulation in the way what preceded it. So on the way up, we have an uptrend in the for the reaccumulation. In accumulation, we actually had a downtrend, and that's the only difference. So whenever I'm going to ask you what's the main difference between accumulation and reaccumulation, That's how you address this question. Accumulation had a downtrend before that. Reaccumulation had an uptrend before a consolidated environment. So we want to look into reaccumulation and specifically label it. How are we going to label it? And then, as we go further into the studies of the bias, then we'll talk more about reaccumulation and the difference, between reaccumulation and the distribution. Actually, let me take a picture of this. Okay. All right. So what are the reaccumulations, the areas of reaccumulations? We definitely should understand that there are different cycles as to how the price moves. There are cycles that are very short-lived cycles, and they exist on the intraday time frame. The longer cycles would be existing on the daily time frame, and then weekly, and then monthly, and then you could even go further with the quarterly and yearly. And within those cycles, within large cycles, like a monthly cycle, a monthly move to the upside, you are going to have your original areas of accumulation. You're going to have some kind of moves to the upside, and then areas of a reaccumulation that would have some elements of the distribution, which are going to be short-term lived elements, that will also have elements of absorption. But once the reaccumulation has been concluded and ran its course, then we're going to resume an uptrend, which is now becomes a very, very much long-term uptrend. And we're gonna go into the uptrend and the resumption of that uptrend. It's these spots, the trading range, the consolidation within the structure of a much larger price cycle, where the price stops, exhibits some temporary weakness, which is being produced by temporary selling, and we could discuss more the reasons of why the selling would occur at those spots. And then absorption of that supply, absorption of those distribution elements, and the resumption of the uptrend. And those, what we are going to call stepping stone reaccumulation trading ranges, could occur on different time frames and at different points of the uptrend. So here we're seeing the same magnitude reaccumulation ranges on the way up. And then we see a different magnitude of the reaccumulation range. And we will have to make that distinction because we will need to understand, how we trade in this. If I'm a swing trader, a short-term swing trader, then definitely, small trading ranges are the ones that I'm looking for, and these are the swings that I'm looking for. If I'm a long-term investor, I really would like to exploit this opportunity, which is a long-term value proposition to me, as I am a long-term investor. And this is the position that I will establish and then hold on to it for quite some time. I also would be looking for the points to add on the way up. So we would just have to be very mindful as to the stepping stone reaccumulation traders occur, how they unfold, and then what kind of trades are available out of those spots to us. Okay, well, let's look at the example of labeling. So this I've taken from Hank's book, which I hope that you all already in possession of. Again, with Hank's book here, chapters 3 to 7 are the chapters that I want you to read. If you read it throughout the course, this is fine as long as you read it. So definitely a really good case study on the introduction of the Wyckoff method itself. And here we're seeing what I call, a conventional way of labeling a reaccumulation. We start with the preliminary supply, then buying climax as a stopping action, biggest reaction to the downside as a change of character, which is also labeled as automatic reaction, and then a secondary test rally would conclude phase A. Phase A, remember, the intention is all about stopping. What are we stopping? We're stopping the uptrend from further movement up. This change of character, phase A, defined the non-trending environment to trading range. And then throughout the trading range, again, we're going to go and define different points, Wyckoff events. We're going to try to define phase C. Anything in between is going to be phase B, sign of strength, backing up action. So from this perspective, everything looks the same as an accumulation, with an exception of the buying climax, automatic reaction, and secondary test. It's almost as if it's reversed, right? So here is the accumulation, selling climax, automatic rally, secondary test. So we have a reversed mirror image of that accumulation in the reaccumulation in phase A. But everything else is the same. We're still going to have secondary tests in phase B. If those are low lows, then this is going to be identified as minor sign of weaknesses. We're still going to have in phase B upthrust attempts or upthrust actions. We're still going to have phase C with the last point of support as a high or low, or spring or shakeout as the low or low. We're still going to have a sign of strength in phase B and a backing up action in phase D. I'm sorry, not phase B, phase D, sign of strength and the backing up action. So all of this is going to be the same. Here is an example. It's not that great because this article has been written quite a long time ago, more than 20 years ago. I believe it was written, oh, look at this, 1992. And it was written by Jim Forte. In my opinion, this is the best article on price structural analysis that has been written, not just recently. And I know that Hank, wrote on that. Bruce wrote in the blogs. But to me personally, it's Jim's article that is extremely important. And this was the homework for you for today, to read this article. If you haven't read this article, go to our website, go to the resources page, and you will find that article. It's a requirement for this course. This is the most comprehensive article on the price structural analysis that I've encountered. And if you don't believe me, here's a story, about this article. I went in 1914 or 13, to Singapore to the IFTAR conference, which is the International Federation of Technical Analysts, and I met their John Bollinger, and John, was his Bollinger Bands. And we were chatting. We were just chatting at the break, and he's like, the best article on Wyckoff on structure was by Jim, and Jim was in the class with me, in actual multiple classes when I was at Golden Gate University. So if you don't take my word as a confirmation of the value of this article, then take the word of John Bollinger. And he said to me that I actually keep it handy. I keep it close to me because it acts as a reference point to me when I look at the structure. Jim has done a tremendous job with this article. And here is an example, which I actually think is not that great. So he talks about the shakeouts here. Well, maybe a shakeout attempts, but definitely looks more like a spring. Actually, I would do more of the horizontal downsloping range like this, but the principles are going to be the same. Phase A is going to be a stopping action of the previous uptrend. Then phase B is going to be multiple tests at the support at the resistance level. And then phase C is going to be your third test. And then the resumption after the sign of strength and the backing up action. I would actually identify a sign of strength a little bit higher because this looks climactic to me. Oh, he has two arrows here, so this is great. Okay, so yeah, really good studies by Jim. So I started thinking about different variations on the reaccumulation range, and in anticipation that students are going to have questions, I'm kind of showing you something that I've developed in a slightly different way. A lot of the times, the first move to the downside as a change of character is going to have characteristics of a shakeout. And then the next rally is going to look like your regular automatic rally in the accumulation. And then your next reaction is going to look like a secondary test. So I started thinking that a lot of the reaccumulations are going to kind of go through a very quick phase of distribution on that first shakeout move. And you could think of 2010 May 6 flash crash as an example, and I should bring this to your attention. So a flash crash like this, and then a quick recovery as an automatic reaction, and then a test, a secondary test. So here we are kind of dealing with the issue that we have two changes of character at the same time. We have the change of character on the way down and then on the way up. So that suggests that the automatic rally is still here. Then how would we label this? Well, obviously this looks more like a shakeout, or sometimes I'm going to put a sell-in climax as a climactic action. So your downtrend is very fast within the context of a reaccumulation. In some instances, you're going to have a push to the upside, climactic action, very small distributional pattern, which would point on the PNF that there's going to be some kind of downtrend. So you have to go through this, and then a local sell-in climax, and the regular accumulation labeling is going to be applied to this. But within the context of a much larger trend, this is just a reaccumulation by itself. So different time frames, right? Different time frames on a secular big or cyclical uptrend, and then much, much shorter term weakness and a downtrend within the context of a much larger trend up. So again, just slightly different labeling that you could apply. If you're seeing all of the shakeout elements and elements of the automatic rally in the secondary test, then I'm actually okay if you label it like that. I'm definitely okay, and I'm going to ask you to label it exactly like this if you're going to have a small distribution pattern, a down move, and then a local selling climax, automatic rally, and secondary test. And again, this is something that you will encounter with your homework and we'll discuss with the homework review. Again, different, it seems to be the same concept, right? A concept of accumulation, a concept of a reaccumulation, another reaccumulation, another reaccumulation, another reaccumulation. And yet, look at the different variations on the same bullish bias. The first pattern shows to us that in 2008 there was a short-term downtrend, and I'm thinking about the 2003 low for Apple, and this is Apple. So this 2009 low on the secular basis acts as a reaccumulation low rather than, a downtrend. But on a short-term basis, we are in the downtrend right here. So here is that schematic that I've just shown you, and it just shows, examples from life. This is how it unfolded. And then as we go to the next meaningful consolidation, this consolidation is a reaccumulation, and it has a higher low in phase C. So it looks like this. This one right here, this is the flash crash on May 6 in 2010. Here is that example where you could label a buying climax, selling climax, or a shakeout, and it looks like a shakeout. Automatic rally secondary test, phase A, test in B, phase C, and relative to the previous low, the flash crash low, this is a high low again, so the same schematic. The next reaccumulation has a downsloping structure to it, so we see that phase C is a low low, like right here, like in this schematic, and it leads us to the spring, and it shows us a sign of strength, and here is a sign of strength, and the backing up action that's going to back up, to the same level of the support that acted before as a resistance. So the linear thinking about the method should always be about the process itself. We are in the trending environment, change of character happens. We are in the non-trending environment. In the non-trending environment, we're going to go through our phase analysis to define bias, timing, and character. Once that is defined, we want our tactics, a layer of tactics in phases C, D, and early E to enter the position and to scale into the position. Then we're going to have an uptrend with potential areas of consolidation where we could add to the position or establish the position. Those are going to be our reaccumulation areas. They are all going to start the same way as other consolidations, with the last climactic run, with the change of character, with the failure to continue the previous move, and therefore with the consolidation around the mean. They could take different shapes and forms, but the process is going to be linear again. You're going to go through your phase analysis, you're going to identify all the Wyckoff events, and then you're going to apply your tactics. And it's going to continue until you actually come into the distribution, and there the characteristics are going to be different. And that's going to repeat over and over and over again. And this whole craft is just about that. It's about identification of the bias. It's about identification of the opening of the position at the most opportune time, where your trade becomes efficient trade, where you don't wait for the trade to happen. It happens right away. And that gives you the most efficient run for your money. All right, so that's a reaccumulation. Now let's talk about the homework. So this homework is going to be for next week. We are going to look at the Home Depot charts. And the assignment is very simple. I want you to label all of the trading ranges that I identify on the slides. And I want you to label those with Wyckoff phases, that's number one, Wyckoff events, that's number two, and changes of character, that's number three. For the ease of conducting this exercise, I want you to print out this slide right here. This slide is going to show you the template with which you should label. It's going to identify for you the sequence of Wyckoff events, sequence of phases, intentions behind the phases, characteristics of all of the Wyckoff events in the consolidation. And after that, I just want you to go to all of the slides. And by the way, I will make these slides available to you. I will explain in a second, how you could get the slides. So you'll have two type of slides. You're going to have PDF slides for lecture, and you're going to have PowerPoint slides for your home assignment. This is just the new innovation for the course that I'm going to try this cycle and see whether it's going to be, more successful. Please note that I don't have the volume signature here, so not all of the charts are going to have the volume signature. This is not necessary at this point of time. And I'm very serious about that. I don't want your minds to be distracted by additional information. It's just not conducive to the understanding of the price structural analysis at this time. Just follow my lead and don't even think about it. So look at all of the trading ranges that I identify with the support and the resistance, and just go through all of them and label them. And then in the next class, we'll talk about all of this labeling, and we're gonna review all of these slides, and I'm gonna give you my solution slides, and I'm gonna look through your homeworks, and we're gonna talk about specific points where you guys, more commonly making the mistakes. That would be a great time for us as we go through the review of the homework, to answer some of the questions that are related to price structural analysis. So I see today some of the questions come, which is great, but a lot of the questions are actually on the material that is still ahead. And obviously I don't want to jump ahead without establishing, very proper basics. So in this exercise is all about the basics. Now let me talk about what's going to happen today and tomorrow, and then I'll go to your questions and comments. If you have any questions, you can type those in. So I mentioned already a couple of times, a couple of things. First of all, I will email you either tonight or tomorrow morning, and I'm gonna email you with the access information on the web page for this class and for this particular cycle. So please, expect the email to come to you. This information is confidential, so I would like to ask you to keep it just to yourself. And then on this page, you're gonna have usually two things: a video and slides. So the video is a player that is built in. So what you need to do when you watch it is make sure that you expand it, right? That you expand the view, and you can watch it on the whole screen. Slides is just a link, and slides you can download. And what I'm going to do for you is, again, I'm going to have a PDF slide on the lecture itself, and then I'm going to have a PowerPoint slide for your homework. It's just going to be easier with the homework if you have PowerPoint slides, because you could work with those right away. You could just narrate them right there and just send those back to me. So you don't have to think about, scanning those or maybe converting them into a different file format. It's all going to be done for you. So just use that. Okay, so access homework What else? Yes, send me with your homework one paragraph. Identify how you heard about us, how you heard about WTC, and then what kind of Wyckoff method history you have. You know, whether this is studies or trading. You can tell me what kind of results you have with your trading. And all of this, by the way, right now, I want to establish that all of the communication with me would go to this address, simpлекot@hotmail.com. The reason why I want to use this address is because it's just faster for me to see right away that you are emailing me. Plus, the wyckoffAssociates@gmail.com email is just for business purposes, and the whole team sees those emails, and it's just distracting for them. So I just want to make sure that all of the emails go to my private email, and I could answer much faster. I'm not guaranteeing that I'm going to answer right away, but I'm definitely going to see it much faster. Okay, questions, comments on the homework or on the material that we've covered today. So let me just see some of the comments, questions here. Okay, a question, multiple questions from Eric here. In accumulation, schematic number 1. Okay, let's go there. Okay. If the move up after secondary test in phase B goes far above the previous high in phase A, so we're assuming upthrust, which is overextended, can we think that we are still in the accumulation? Okay, so this is a question kind of like in the moment, right? So for instance, if the price goes up, are we still in the accumulation? Well, by the definition, of the higher highs, higher lows, here we already would be in the uptrend if this to happen. In some instances, the upthrust could be overextended, but still will come back into the trading range. That's just the definition of phase B, right? So phase B here is going to suggest that the test at the level of the resistance could have either a failed upthrust attempt or it's going to have an upthrust attempt. I'm sorry, upthrust action. So therefore, upthrust by itself concludes with the return below the support line, below the resistance, right? So therefore, by definition of the accumulation, the price will come back. In the case that you're describing, Eric, with the price just going up, up, up from here, then we are in the uptrend, and I would be questioning if this type of structure is just phase C of a much larger formation. So you have to think about that. Okay, next question. Okay, so the main thing in the reaccumulation is phase A. That is similar to phase A in the distribution. But phase B is the only difference that I could see with the sign of weakness that goes below the automatic reaction in the distribution. Eric, again, I like all of the questioning. I think that we're just jumping a little bit ahead. So I would just say, like, stay patient, and it will come to us as we're discussing in the next 2 sessions. All of those elements will go through the homework. But a very simple, quick answer to this is that, there are quite a few things that we will be discussing as to how to define the bias. And yes, you're right. In the redistribution, the first 1/3 of the range, in the reaccumulation, the first 1/3 of the range could develop the same way as a distribution. It just starts with the same stop in action, change of character, and the secondary test. So it's gonna look the same. It could look different price and volume characteristics. That could be the distinction. But again, the goal for this course, for this particular 4 months, is for you not to necessarily give the bias in phase A. I'm kind of teasing you a little bit with that material because I know that we discussed this in the practicum. But for now, this is not the time to discuss that. For now, I just want you to remember that reaccumulation distribution is going to start the same way. So it's going to have the same labeling. And then as we go through the trading range, this is where we want to define the bias. Would distribution show up, or would reaccumulation show up? And that's how we're going to determine what to do next. Can you address some differences in phases B to discriminate phase B of the reaccumulation and distribution? Kind of the same thing, right? So this is more advanced as a material. We're still on basics, so we're going to discuss those probably even more in practicum, like phase B, definitely practicum, because this is one of the hardest phases that we will be discussing. So with that, just, everything is ahead. Don't worry about this. We will definitely, get to all of this material. The main key right now is absorb all of the basic and absorb them at the good level. So that's the home assignment. Okay, guys. Well, that's it for today. Okay, quick last question. Is Wyckoff methodology suitable mostly for liquid stocks? From Nilesh. No, we could definitely use some of the examples of the liquid stocks as well. Now, the methodology will be applied in slightly different way there, and we can talk about this. This could be, Nilesh, this could be a really good question for session number 15, which is going to be a Q&A session. So once we understand all of these concepts, a question like this will be just perfect. All right, guys. Thank you for all of the questions, even though we really did not have a very interactive session, but still really good second session. We've covered a lot of material, which pleases me a lot because we've got a lot to cover, in the next couple of sessions, even just on price structural analysis. Please do your homework. If you have more time, watch this recording again. Create your notes, send those to me. But send me your homework to simplekot@hotmail.com and send those before the class, not in the last hour, I beg you. If you're going to send me in the last hour, most likely I'm going to be busy just preparing for the class. I will not even see it. Send me all of your homeworks before 12 noon on Monday and preferably on Sunday, or, at any time on Sunday. Or if you could do this even before Sunday, even better. All right, guys, that's it for today. Expect my email with the access information, and I will be expecting your emails with the homework. I will see you next week at the same 3 p.m. Pacific. Happy trading until then, and thank you so much. Bye-bye.